Welcome to the Tech Today podcast with your host, John Maeda. So in the past, you've heard me be critical of CPI not telling the full story around inflation. Real world inflation is much higher than CPI. All you need to do is take a trip to the grocery store. Another measure of inflation is growth in the money supply. So in the old days, the Fed itself used to define inflation as growth in the money supply. And then what happened is the Fed created so much inflation in the 1970s that it changed the definition of inflation to growth in price increases. And so let's plot CPI versus growth in the money supply. So what you're looking at here is the month-over-month, or rather the year-over-year change in CPI as measured each month over the past 10 years. And so sort of this little mini mountain on the right-hand side, that is the percentage change post-COVID, as a result of the money printing that the Federal Reserve did. So let's look at that money printing as it relates to the money supply. So let's add, and watch how this distorts the graph. We'll add M1, the most narrow definition of money, which is currency, demand deposits. And let's narrow that to the past 10 years. And you can see how M1 spiked as a result of the trillions of dollars of printing that the Fed did. I'll include a link to these charts, or to this one chart, and then you can manipulate it yourself in the YouTube show notes. And if you scroll down here, here's sort of the definition of the money supply for M1. I'm going to add M2 in a moment, and its definition will be at the bottom there as well. So, I mean, you can't even see the year-over-year change in CPI as measured each month, which is this blue line. You could barely make out CPI, given that the change in M1 is so great, and it just sort of distorts the whole graph. So let's edit the graph once more. And let's add M2, which is a broader definition of the money supply. And that's what most of these economists are talking about when they refer to the money supply. Most of them are talking about M2, and I'm going to remove M1 simply because it distorts the graph so much. And so there's M2. Let's look over the past 10 years. Blow that up. And this is more like it. This is more like the real world inflation that we experience. When you look at M2 or M1 for that matter, M1 is included in M2. And so another way I like to think about it is that the inverse of the growth in the money supply is what happens to the purchasing power of the dollar. The dollar gets diluted every time the Fed prints. Just like when a publicly traded company issues new primary shares, the value of the shares outstanding get diluted. And it's the fact that money supply growth has rolled over and went negative last year that's pulling down the economy now. And then, of course, money supply growth, and I know both lines are being highlighted here in this chart, but the green line is M2. Money supply growth occurred in March of 2023. That's when, of course, the Fed rolled out its bank term funding program, and so that bailout was QE. So when people talk about a hawkish Fed, I mean, yes, they were running a QT program, which, by the way, was a lot weaker than the old QE program when they were buying $120 billion of bonds each month. But while the Fed was running its QT program, and it's still running the QT program, it's running a backdoor QE program in the form of the bank term funding program. So it's not this hawkish Fed that Powell would like everybody to believe it is. So from my point of view, I've always thought about money supply growth as a better measure of inflation than CPI. CPI is a government manipulated number that vastly understates the impact of real world price increases. Money supply growth tells a better story as to the damage that's been done by this Fed in the fiscal side. Both are complicit in this massive inflation that we've suffered since the end of 2020. That's all for now. We'll see you next time.